Welcome again to the Brunston Market Update. I'm Brian Moorman, CEO of Brunston Asset Management and Brunston Financial Services. Today we're pleased to have with us Frank Atkins from Brooks Macdonald, who is one of the investment managers who looks after the Brunston investment funds. Welcome, Frank.
Thank you, Brian. Nice to be here.
Frank, one of the biggest questions that we get asked these days is with regard to the upcoming referendum. How does the possibility of Brexit affect the funds?
Well, the first point that I'd make regarding Brexit is that we don't make any large asset allocation decisions based on the outcome, based on what-if scenarios. We're long-term investors and we look to provide returns across the whole of the economic cycle. Now, in any economic cycle, there will be political events such as referenda and such as US elections. That said, we are cognizant of the fact that there are areas of the market which are more exposed to Brexit risks than others, and that is why we've recently made a decision to increase our allocation to the large and the mega cap UK companies and decrease exposure to the small and the mid cap. And the reason that we've done this is because the larger companies, they have globally diversified income streams, and what that allows them to do is it provides them a cushion against the fall in the value of sterling and the euro, which is a trend that we've seen since the referendum was announced. It's also a trend that we don't think will be reversed until we get an outcome of the referendum either way. Our base case scenario, however, is that the UK will vote to remain, albeit by a narrower margin than the polls and the bookmakers are suggesting. And I think if we do see a vote to remain, we will then see a boost for UK economies alongside an uptick in the price of sterling against the euro, and that will hopefully provide us an opportunity to deploy some cash and to make some profits.
Thanks, Frank. There is, however, a lot of market volatility at the moment, and on the lead up to Brexit in particular, this seems to be even more so. What are your thoughts and comments on that?
Well, the volatility that we saw at the start of the year was a result of three main factors. So firstly, you had concerns that an interest rate rise from the USA would negatively impact the global economy, and it might not be strong enough to withstand an increase in dollar strength. Secondly, you've got the fall in the oil price. It fell to below around $30. And this also raised concerns that companies whose earnings are linked to oil may end up defaulting on their bonds or perhaps having to slash their dividends. Thirdly, and perhaps most importantly, is China. There were fears that what China would do in order to stimulate economic growth would be to devalue its currency. And the problem with the Chinese devaluation would be that it would be immediately followed by devaluations from other emerging market economies in order for them to remain competitive. And all that would do is it would add to the deflationary pressures that are already on the global economy, and essentially you could come into a downward spiral as a result of that. Within the funds themselves, we look to include positions which can take what we call shorts on markets. And what shorts do is they allow you to make money when markets are falling. And so if we can do that, then that can allow us to mitigate some of the downside. Essentially, eliminating risk comes down to effective diversification, both at an asset class level and within certain sectors of particular markets. So if we use the FTSE 100 as an example, during January, that market, like most equity markets, fell quite heavily. However, there were parts of that market, such as the tobacco stocks and the utility stocks, that actually made money. They actually rose. So if we can ensure that we are sufficiently diversified across the sectors, then again, we are able to mitigate the worst of the losses.
Okay. You mentioned the oil price and how that's affecting the global economy. I wonder if we could talk a little bit more about the oil price, because it seems to have varied quite a lot over recent times.
Certainly. Well, when you're analysing the oil price, it's important to consider whether the fall was caused by a lack of demand or by oversupply. Now, if you use a lack of demand as your base case, then that is unfortunately negative, because a lack of demand indicates a decline in industry, a decline in manufacturing, and they're both signs of an oncoming recession. However, if you take the opposite view and you consider the fact that it may be an increase in supply, which has caused the falls, then that is actually in some cases can be quite positive, and I'll explain why. So the oil price fall can benefit not just companies themselves in terms of the earnings and the profits that they make, but it also affects the man in the street. If you consider when you go to the petrol pump and the price has fallen from perhaps the previous week or month, you've then got more money in your pocket to spend on other things. And that spending, that discretionary spending, can provide a boost to the economy in general. Within the funds themselves, we don't have any direct exposure to oil. And like I say, it is our contention that over the longer term, the drop in oil price will provide an inflationary boost to equity markets.
Thanks for that, Frank. Another question that we get from a lot of clients is, looking over the longer term, what opportunities and indeed threats do you see up ahead?
So there are two main threats to the global economy. The first is interest rate rises. The Federal Reserve must ensure that the speed that it raises the interest rate and the amount that it raises the interest rate is correct. If they do too much too soon, then that risks choking off demand in the economies which are still in the recovery phase, because what it will do is investors will then rush into dollar-denominated assets. The second key point is that central banks, the stimulus that they're currently providing, the markets have to retain their faith that will provide the support that's necessary to induce some much needed inflation. This is especially true in Japan and also in Europe. If the markets were to lose faith in the ability of the ECB or the BOJ to provide that stimulus, then I think we could see a sell-off in risk assets. Overall, we do retain the view that things will pick up in 2016 as we progress through the year. I think a resolution to political issues such as Brexit will allow investors to start examining the market fundamentals again, and we do share the view that these fundamentals are positive. And hopefully overall that will lead to a pickup in markets as we move throughout the year.
Thank you, Frank. That was very interesting and very informative, and I hope it was also for yourselves. Should you wish to have any further information with regard to the IFSR Brunston Asset Management Funds, then please be in touch with us in the normal way. Thank you.